Thank everybody for coming out today. Rob mentioned that some of the success recently has been about a 1 out of 10 in certain parts of the world. We're probably closer to a 9 out of 10. I think we're picking up the other, the bit that's left behind. The story of where our company is ties into the U.S. and what's going on in the U.S. And what we're seeing is in the U.S. has global implications. And some people are aware of this, and with the changes that are going on in the UK specifically this coming year, with the opening up for another licensing round, allowing horizontal drilling and fracking. This technology is something that started in the US, started about 20 years ago, or really got improved 20 years ago to where it started having an impact. It continues to improve. Let's dive right into that, where we are. Tom also mentioned that a step change was needed. 2 weeks ago, we just announced our step change, so we'll get to that also. We were presenting about a year ago, and this slide had a different headline. It said that America to be the #1 oil producer by 2017. We changed that because this year we've surpassed Russia and Saudi Arabia. We're now the largest oil producer. Now, we are an oil and gas exploration and producing company, but we're also very much a technology company. These changes of what's taken place are all about the technology. It's about the ability to do the horizontal drilling and fracking. During a 30-year period, the U.S.'s reserves had dropped consistently for 27 years. The last 3 years of this 30-year period almost regained everything that was lost the 27 years prior to. Okay? This ended in 2011. Since then, it's continued to climb. I think that'll also continue from here on. The reason for this, as I said, is the technology. The horizontal drilling and fracking is a type of tight rock. The shale that they're doing this in is a tight rock. The horizontal drilling would open up the formation to where you've now exposed the wellbore to so much more of the formation than a typical vertical well. With that new portion opened, now you've got more reason to try and open up that tight rock, or the shale as it were, and the way to do that is by fracking. The shale plays continue to evolve and evolve over the last 20 years, and they're continuing today to the point where the gas prices had dropped significantly. And as we stand today, we're no longer importing gas. We actually have 3 terminals that have been turned around, they're reversed, and we're an exporter of gas at this point. The U.S. is exporting gas to the U.K. of all places. We're taking the same technology and we're applying it towards other tight rock. We call it tight oil, but other formations that are tight but that are oil prone. I'd rather drill for $80, $100 gas or oil as opposed to $4 and $5 gas. So that's where our focus has been, is looking for these other tight plays, tight oil plays that have not been introduced to the technology. The Bakken's an example of this. This was an early play. And this chart here shows what's happened from the 50s when they were doing the vertical wells all the way up until 2009. And you're looking at the changes in the technology, specifically the way the horizontal wells were drilled. The length of the laterals had changed, the way the fracs had been done from a single frac to multi-stage frac, etc. This is a better visual of what's happened over the last 3 years of that period, from 06 to 09. And the column to pay attention to here is the F&D, the finding and development cost per barrel of oil. When these wells improve and the recovery of these wells improve, what you have to pay to get the land, your leases, effectively, the lease costs continue to escalate. If there's oil that's there and it's a resource play where it's repeatable and you can get this oil, then your risk goes down significantly and you're willing to pay more to get that. So the F, or a big portion of the F, the finding, the lease cost, would continue to increase and increase. But it's been offset so much by the recovery that over a 3-year period, you've gone from $35 a barrel down to $11 a barrel, a third of what it was over a 3-year period because of the effectiveness of the horizontal drilling and fracking. Now on to Nostra Terra and how we fit in here. Nostra Terra had started back in 06, listed on the exchange in 07, and people often ask the question of why I'm here, why I'm in the UK, if we've got US assets. The company originally has its assets in Ukraine, specifically in the Crimea Peninsula of all places. Okay? They came to me in '09. They had $2 million debt and 1,000 pounds cash in the bank. They were a day from administration the day that I took over the company. We restructured the company. We refocused on the U.S. We looked at what was going on, the change in technology. We thought this would be a very good place. It's a very good time to get in and start making some real money as opposed to what was going on with the company prior to that point. Since then, we've been building up carefully, cautiously, but we are cash flow positive. We've got a $25 million credit facility in place from Texas Capital Bank, very large facility. They're backing our play, our plan. They like what we're doing. They like what management is after. They like the assets that we have. So we've got a $25 million facility. We have not used just a fraction of that. We've used $1 million of it at this point. But we have that to grow. They're backing what our plans are. And again, our focus is the new oil from old fields. We're going into these old fields. The reason why we have such success, of repeated success in these wells, is because we are going into the old fields, the old sleepy areas, but we're using the new technology to get what they never got before. Mid-continent U.S., if you look at the green and the red, the green being predominantly oil, the red being gas, but it's obvious where the hydrocarbons are in these two areas. We're focused in the mid-continent, Texas, Oklahoma, Kansas, the edge of Colorado, we've got some assets, and our newest assets over here in Wyoming. I think this is a real good example. Each square here is a square mile. It's also known as a section. It's 640 acres in size. If you look at every one of these dots, these are existing wells. The ones with lines through them, which is nearly all of them, are wells that have been plugged and abandoned. They've been drilled over the past decades. There's no oil left. They've shut them down. They've plugged them. They've abandoned them. There's nothing that's going to happen again on those wells. There are a few wells you can spot here and there that are still producing. Production on most of these range from about a barrel a day to 5 barrels a day. They're called stripper production because you're stripping the last bit that's left. It's usually worked by a local. They're not economic enough that a bigger company can go in, so little locals who have been in the area, they can afford the economies. They go in and they work these assets on a daily basis. They wake up, they get out on site, and they work a few barrels a day. So if you were to go in and look for places to drill today, you would not want to drill here. This is an old area. There's nothing going on. You've got better places for your money, as it would seem. However, geologists have gone into this area approximately 3 years ago, and they said, this is tight rock. This has not been exposed to modern technology. This was drilled with old technology. We think that it would apply. Now, if you've got an old sleepy area like this, it's not real easy for a geologist to convince the boss, let's go ahead and spend $5 million and see if there's something worth having. The argument's strong enough, eventually somebody comes around and they did that. You get the first horizontal wells that are drilled, approximately a mile in length, just shy of that because you can't cross over onto somebody else's leases. But you're drilling down, and these red lines are the horizontal wells. So again, in these old sleepy areas where there's nothing left, we're drilling 2 wells per section as opposed to the several wells on the 40-acre spacing that were drilled before. And each of these wells are recovering about 500,000 barrels per section. Okay? To put it in simple numbers, when I gave you the 1 to 5 barrels a day, these wells are coming on at about 400 barrels a day, next to wells that were producing 1 to 5 barrels a day. Was there any oil left? Was it missed before? It's very obvious why we've gone back in. We've gone into these old areas. We're not going into old well bores. We're going into the old areas. We're drilling in between these old well bores, and we're getting all the oil that was never even touched, not even close before. So this is why this is a little example of what's gone on in the big picture of why the U.S. has become the #1 oil producer again. Okay? I think that's going to continue as exploration companies are looking for the other plays that they can go and expand. People have also asked me, they've said, well, you know, if you've got these bigger companies around, well, then there must not be anything else that's left. This was 3 years ago that this play started. We got into this exact play about 2 years ago. Leases at the time when we got in were about $150, $200 an acre. We were paying about a 20% royalty. 2 years later, because of the consistency, the resource play that this has become, the leases have gone from the $150 to $200 on up to $1,500 to $2,000 an acre. Now, if you wanted, and if you were possibly able to pick up anything in here, that would not be the $1,500 to $2,000. The $1,500 to $2,000 is on the flank, outside where people hope the play would extend. Everything in here, for the most part, is leased up. So this is what we've been telling shareholders, what we're looking for. We have 20% of what Ward Petroleum has in this area, but we're looking for our own prospect that we can start with a much larger portion, possibly up to 100%. But we want to have a large portion that we control, that we operate, that we get in at an early stage, that hasn't been exposed to the modern technology, where we can go and have similar success. 2 weeks ago, approximately, we just announced our new acquisition, the White Buffalo, in the Bighorn Basin in Wyoming. This is not a well that we've drilled recently. This was drilled back in 1922, but it is in the area where our leases are. We have 100% working interest, 6,000 plus acres that have never been exposed to modern technology. There have been a few wells out of 200 analogs that we've gone through in our area. There have been just about a dozen wells that have been fracked with a light frack. We call it a tickle frack. Very old technology, 20, 35 years old, nothing modern. And of those wells, the handful of wells that had that had a 20% success, a 20% improvement over the other wells that were not fracked. So we're looking at that as one of the examples of why we want to go in and put a modern technology on that, a modern frack, a horizontal well, and frack that and see what happens. We've got third parties that have come in on the back of what we've done. We've asked a geologist to come in, a third-party geologist, 2 drilling contractors, a reservoir engineer, and another third-party geologist for another aspect of this. The figures that we've come back with are 13 million barrels recoverable in our 6,000 acres in one formation. One of the contractors, the geologist, had said that this makes for a very appealing geological perspective. Most factors for an unconventional play seem to be present. That's a simple quote. Let me tell you what the other geologist said. He said that the area is big enough that he thinks we could be looking for an elephant. And I said, well, isn't that what we're all looking for in the business? He said, but Matt, seriously, in the 35 plus years that I've been doing this, this is one of the most exciting exploration prospects I've seen. We agreed with him. We weren't looking for the validation, but we were happy to hear that. We've run our economics, and the per well on a PV10 is $5.9 to $11.8 million, $6 to $12 million per well. We have 20 potential locations. That gives you a value of $118 to $236 million off of our current estimates. Okay? Again, from the single formation on our existing leases. We're drilling for the tight oil, as I said. A saying that has been used for some time, the best place to look for oil is where oil's been found. I think I've explained exactly why we want to do that, why we've been doing that. We're going into these old areas, we are finding the oil. This particular area we're real excited about, something that we did not know when we started, and we did not need to know necessarily. We had our own confirmation of why we wanted to be there, but what we discovered when we had the property in escrow, but prior to closing, we found out that a company with a $6 billion market cap, SM Energy, has just permitted and actually spud. They've just started drilling their first horizontal test well in the same formation that we're in, just miles away from us. On top of that, a few days later, we discovered that another company with a $30 billion market cap, one of the larger in the U.S., has 2 wells permitted and located, and they're getting ready to drill 2 wells even closer to us in the same formation. So it becomes a very exciting story of what we're after, the step change you can see on why we've done this. And now we're ready to continue to grow from here.